Please subscribe, like, and hit that notification bell. Thanks, guys. Want to do it? You want to do the honors, Kevin?
Sure, Pat, sure thing. Hey, everybody, it's Kevin Wadsworth and Patrick Karim, North Star Bad Charts, of course. And we've been telling you guys that we're going to be talking to Brent Johnson this week, and there couldn't be a better time, I don't think, than right now. Talk about good timing, Brent. It's great to have you with us. How are you doing?
Good. Yeah. Thanks for having me. It's it's an interesting world for sure. And I'm looking forward to hearing your guys' thoughts on what's going on.
Yeah, it is an interesting world for sure. We've had all sorts going on since we last spoke. Of course, we've got a new incoming president in the United States, and that's sent shockwaves, I was going to say, through the system, but around the world. And the technical charts, of course, are reflecting what is going on. Myself and Pat have been looking at the technical charts, and of course, you're really on top of what's going on from a fundamental point of view and from the point of view of course, the US dollar index. And when I said at the start that this was a great time to be catching up, it really is. I think Pat's got a chart that he
Yes.
can just show us. And we're not going to show a lot of charts. We don't want to bamboozle everybody with charts and sort of overcome what it is that take over what it is you've come here to talk about. But the one chart, of course, that we do want to show everybody is this US dollar index chart, because I think when it broke down, I posted on social media there on X that I suspected that an upside resolution was coming, and there was a good number of technical reasons for that. The US dollar index was actually finding some serious support down at that level that it dropped to, and as soon as it started to react at that level, we've got a number of moving averages and the Ichimoku cloud and a few other technical indicators there. But regardless of that fact, we now have and this is quite an important point actually from a technical point of view, a false breakdown and a rapid upside reversal through the apex of that triangle. Now, that's what happened when the 10-year yields broke out a couple of years ago, and we saw the 10-year yield had been declining for over 40 years, and then it exhibited this pattern it was actually a falling wedge, false breakdown, rapid upside reversal, and you see it a lot in technical analysis. It's a sort of a gets everybody wrong-footed, I suppose, in the markets. But we've got a clear breakout there now, Brent. And I think the question on everybody's lips is this breakout for real? Is it going significantly higher, or is it going to reverse again and come back down? So maybe just talk us through the dynamics of what you see going on there.
Sure. I don't know if you have the ability on that chart, but do you have the ability on that chart to zoom out?
Yes, yes.
And go
I'll come.
so bring the chart back up and zoom out to, like, I don't know, 5 years ago or something. Or to do a 10-year chart from 2015.
There you go. 2015, okay. Right here.
Yeah, so I think if you look at this chart from 2015 to 2020, the dollar index kind of bounced around between, let's just call it 90 and 100, right? Just broad strokes. And then, with at COVID, it went to 103 and then came back down, tested 90 again. And then it obviously had the very big jump in 2022, subsequently came back down, and now it's come back down and it's tested 100 a couple times. And the reason I'm highlighting this is it would not shock me at all if we have another 5 years where the dollar just bounces between 100 and 110 or 115, whatever the number is, the same way it bounced between 90 and 100 for 7 years or 6 years or whatever it was. My kind of argument has always been not really so much from a technical perspective, although once you kind of get above 115, there's not really anything to stop it, right? from a technical perspective. It's just, my point has been from a systematic perspective, this whole narrative of de-dollarization, because the world doesn't want to use dollars anymore, is a fundamental misunderstanding of how the system works in the first place. And the fact that the whole world uses dollars and therefore has borrowed in dollars makes it really, really hard to just walk up and leave without causing chaos, which then in that interim period pushes the dollar higher. And so because the whole world has all this debt that they have to deal with, central bankers and monetary authorities are somewhat limited in what they can do. But the key is that the US has the ability to control monetary policy for the whole world, while the rest of the world only has the ability to control monetary policy for their own country. And so if we ever were to get in a situation where the world was trying to de-dollarize or leave the dollar system or hurt the US via the dollar, all the US has to do is raise interest rates, and it's like a stealth weapon that just crushes everybody else's economy because everybody else has borrowed in dollars. And I'm not saying that every time the US does raise rates, they're doing it as a weapon, but I know for certain that they know that it works.
Yes.
Let me just put it that way, right? And so I don't think in 2022 they were necessarily trying to hurt the rest of the world. But anybody who thinks they weren't aware of what they were doing is extremely naive as to the biggest weapon the US has, which is the dollar. And so my pounding the table of the dollar going higher in many ways has really just been to provide a counterweight to all of the people who constantly, pitch the same hyperinflation of the dollar. The US is broke. It can only go down. Everybody's going to leave it. And the thing is, the ironic thing is I'm kind of sympathetic to that point of view. I mean, I get it. I understand why people think that. But once you really dig in and understand the mechanics of the system, you realize that as much as you may want that to be the case, it just doesn't work that way. And so I've tried pretty hard to explain the mechanics that keep this de-dollarization thing from happening. And I wish you guys are probably, to be really honest, you guys are probably better from a timing perspective when all this will happen, because you guys are technical analysts or you guys analyze charts. I look at charts and I kind of understand them, but my view on this has always just been from a systemic fundamental level. This idea that the dollar is going to go to 60 or 50 or whatever it is, and everybody's just going to leave the dollar, and all those dollars are going to come flooding back into the United States, and we're going to have hyperinflation, and the rest of the world's going to have a picnic. I don't want to say that can't happen, because anything is possible, but that is such a small statistical possibility that to me, it's not even worth talking about. Because the reality is, and let me just make this point, and then I'll be quiet. And the reason is the actions which would lead to the dollar going lower in the short term necessarily mean that the debt in dollars is getting bigger, which causes a bigger problem in the long term. In other words, to provide the liquidity that is needed to push the dollar to 80 or 60 or whatever somebody's target is, that liquidity is provided by new debt or new credit being created. And that new debt and that new credit is denominated in dollars. And so if you believe that debt matters in the long term, the actions which lead to the dollar falling in the short term necessitate it rising in the long term. So, and I know that that's kind of hard to get your head around, but from a systemic perspective, that's how it works.
Do you think, so if the US goes in hyperinflation, probably all the other currencies are also going in hyperinflation, right?
Yeah, the US dollar cannot go into hyperinflation before the rest of the world does.
The rest of the world does. What?
The rest of the world's currencies are all derivatives of the US dollar.
Yes, that's tough.
So my friend Keith Weiner has a very good analogy, and so I'm going to steal it. I'm going to give him credit for it. He said it would be like thinking that you have calls on Apple. You have call options on Apple, and Apple's going to go bankrupt, but those call options are still going to have value. That's what it would take for the rest of the world's fiat currencies to still exist while the US dollar is going through hyperinflation. And the reason is because all of those other currencies, all those other central banks, they all hold dollars as reserves. Their balance sheets have dollars on them. They have treasuries on them. They have US-based assets on them. So the idea that the US assets are going to disappear, but everybody else's balance sheet's going to be okay, it's just fundamentally wrong. I don't know how else to say it.
Yes. So the US does not have the foreign currencies on their balance sheet.
I think they have a very small amount, but it's I think some of it is the result of swap lines being extended. So if we give a swap line to the ECB, they pledge euros in return. And so I think that the US does have a very small nominal amount of foreign currencies. But the thing is, they don't really need foreign currencies because everything takes place in dollars. So yeah, I mean, they could go buy them, but why? I mean, so it really all goes back to this idea of global seigniorage. And seigniorage is when the biggest, strongest guy, or the person in power, the king, the monarch, however you want to describe that, had the ability to quote unquote print money. And while all countries use a fiat system and they have the ability to print money within their domestic borders, the US has the ability to do it for the whole world. And
So, Brent,
they don't have to go hold reserves.
Just one point there, and I think people watching this might be just sort of going through their minds that you say that everything takes place in US dollars. Does that mean that you think it's going to take quite a long time, or a very long time, for countries like Russia, China, for example, particularly China, to de-dollarize, to transact internationally without involving the US dollar? I know they're building their gold reserves. There's no secret around that. Russia and China have been, building their gold reserves enormously for a long time. So, my question would be, at what point do you think countries like that, will have been able to, bypass the dollar system?
Well, so there's a difference between countries starting to not use the dollar and the dollar losing its global reserve currency status. So let me just start off by saying that. Now, China, Russia, some of the BRICS countries, I'm not saying they can't de-dollarize. I'm saying they cannot de-dollarize without receiving an incredible amount of pain in exchange, right? Deleveraging can be done. It's just that deleveraging really hurts, and it's a painful process. And in some ways, it's better to do it all at once and just clear the table. But the problem is, it's really hard for politicians to stay in power when they cause that much pain, right? So of course, they always try to do it slow and easy in a way that doesn't cause too much disruption. But so going back to your question, I think China and Russia, in many ways, the world is de-globalizing, right? Let's just say from 1980 to 2000, 2010, whatever number you want to pick. The world was getting closer together. It was working together. It was becoming a more globalized one economy world. And I'd say for the last 10 or 15 years, 20 years, depending on how you want to look at it, it's starting to de-globalize, and you're starting to become, these regional blocks are starting to spring up. And, with the BRICS and post-COVID and, the Russia-China alliance, I think we are going to have a more fractured world. And so within those different regions, I would expect some kind of trade in local currency, or barter or whatever it is, to rise. But that is not a bad thing for the dollar from a price perspective. Now, that is a way that the system could change. But my point has been that for the system to change, the dollar goes higher in that process. So the dollar goes higher, then we have this totally deglobalized world, and then the dollar falls, right? But in that process of change is very chaotic at a minimum. And all you have to do is look at a 25, 30, 40-year chart of the DXY index and overlay it with any kind of global crisis or regional crisis, and you will see that during every economic slowdown, every crisis, every whatever flare up, the DXY rises. Yes. And that's because it's the base of the global monetary system. It makes sense. In a deleveraging, which is what always causes economic pain, the underlying collateral rises in value while the asset values fall in value, right? That's how it works. And because the dollar underlies the entire world economic system, that's why it rises. So in other words, if the dollar was falling, there's no crisis. The dollar falling is the status quo continuing to work the way it's worked for the last 20 years. it's really hard. It's a really bad thing for the global reserve currency to be rising. From a systemic perspective, it's a bad thing because that's what it's a debt-based system. So everybody has debt in the denominated in the world reserve currency. So if that underlying currency is rising in value, that puts pressure on the assets that have been purchased, right? I think most people know that over long periods of time, fiat currency loses value, including the dollar. The problem
And
is all
that
go,
that actually brings me to a question. Just whilst
yeah,
we've got a list of questions from our from people who follow us on social media and website members, and what you just said there sort of ties in with one of these questions, which is to ask you if you think the DXY is a flawed or fair measure of the dollar's relative strength.
Well, so it's a flawed measure of the dollar's strength on a global basis because the DXY is mainly the euro and a handful of other countries. But go look at the Asian dollar index. Go look at the Bloomberg dollar index. Those have done even better than the DXY. So I agree that the DXY is not a great measurement of the dollar on a global basis. But I would say the dollar looks even better if you were to measure it against individual currencies around the world. The second thing is just because the DXY is rising doesn't mean its purchasing power is rising. And I've been pretty clear about that since the very first time I ever mentioned this. When I talk about the dollar rising, I'm talking about it versus its peers, right? Its peer currencies. And when I first started talking about this, I said, we're going to get into a period, I don't know when, but as the system really starts to buckle, you're going to see the dollar and gold rise together. And the very first interview I ever gave on this, I said I thought what the driver of gold going higher along with the dollar would be the rest of the world, not the US, but the rest of the world trying to get out of their fiat currencies and get into gold because their fiat currencies would be doing even worse than the US dollar. And if you look and see over the last 12 to 18 months, who have been the primary buyers of gold? As we've seen this historic run up in gold, it has been driven primarily by buyers in Eastern Europe or Asia. You look at in the US in the ETFs and stuff, that hasn't been the driver of gold going higher. And the reason is because in the US, the dollar has held up pretty well. I mean, don't get me wrong, it's falling in purchasing power, but not the same way it has versus the rest, not the same way that the rest of the world has fallen. And those other countries have to protect against their own currencies. And that is why they have been in other words, when somebody in China or somebody in India or somebody in Sri Lanka or wherever it is goes and buys gold, they don't walk up to the counter to buy their gold and say, that Jerome Powell is out of control, I got to buy some gold. They're worried about their local currency. That's why they're buying gold. They are used to dealing with a government that doesn't live up to their promises, that devalues the currency, that, in many cases, they're an autocratic regime. And so gold is one of the few places that they can protect their purchasing power. Now, does that work in the US as well? Yes, it does, but not to the same extent that it has around the world. And so I've tried to be as clear as possible that everybody should own gold. My thesis has never been an anti-gold thesis. It's just been a clarification that the dollar is going to rise versus foreign currencies. And the reason that's important, and this will get back to this 25 or 30-year chart that I was talking about earlier. Because we're in this era where all fiat currency is losing value, all the debts are so big, monetary policy around the world has had to take extreme measures. There's become a growing awareness that fiat currency loses value, and so everybody should get into real assets because the only choice is for the central bankers to inflate the problem away. And so I feel like there has been, as a result of that knowledge kind of percolating up to the average person level, this theory that you just buy real assets and everything is fine has become kind of this popular mantra. And it's not that that's wrong. I don't want to say that that's wrong, but it's not that easy either. because people will then say fiat versus fiat doesn't matter. Who cares if the dollar is rising versus the euro or the yen or the ruble? If all fiat's getting devalued, who cares if fiat's going higher or if the dollar's going higher? The reason it matters is because one currency going higher versus another currency, another one fiat appreciating rapidly against another fiat, has oftentimes been the causing factor of a crisis, either a regional crisis or a global crisis. And what I mean by that is when carry trades go wrong, when one country, you look at the Mexican tequila crisis back in the early 90s, that was a carry trade gone wrong. That was fiat versus fiat that caused that. If you look at the Asian debt crisis and the Asian currency crisis in the late 90s, that was a carry trade gone wrong. If you look in 2008, in many ways, that was a global carry trade because everybody owed dollars. And as the global system started to, the dollar rose during the financial crisis of 2008 too, because the whole world was scrambling for dollars. You saw it again in 2020. The reason the dollar went from, so I'm going to take a step back. In early 2020, the dollar was around, let's call it 95 or 96. And leading into March, it went to like 98. And I don't know if people remember this or not, but the Fed came out and did, as COVID started to become known, the Fed came out and did an intra-meeting cut in order to provide liquidity to the market. And when they did that, the DXY went from 98 to 94. 10 days later, the DXY was at 102 or 103 or something like that. And the reason was because in that subsequent days, even though the Fed had cut rates and were probably going to do more, in that 10 days, the music stopped and the whole world was scrambling for chairs.
Yes.
And the chairs are the dollars, right? And so that's what pushes the dollar higher. And so, I kind of got off on a tangent there and rambling. The point is that you're not going to have a global crisis and the dollar falling, because the dollar falling is what provides liquidity. And how can you have a liquidity crisis when you're providing more liquidity? Did you see what I'm saying? So in other words, if the DXY goes from 100 to 80, that's a lot of liquidity being created. So, it's hard to see that being a crisis. But if it goes from 100 to 120, that's going to cause some problems.
That's right. We have this thing called the capital rotation process or capital rotation event. It's these areas where, let's say, gold breaks out versus SPX and everything measured in gold starts tumbling after like a 10-year bull run. But also the DXY is one of those check marks. We need a DXY breaking out. We need and often with the VIX also, you could overlay the VIX and the DXY there. When the VIX goes crazy, the DXY goes up. And right. Yes, so what people want to know is also, what's like the target? Like, let's say me technically right now, I might have a 117 target for DXY, but I think I've heard you say like a number way higher than 117, right? Right?
Yeah. I mean, first thing I'll say is I think a lot of times people make calls and then when they don't come true, they kind of wander off into the distance and never bring it up again. And so, I started saying in 2018 and 2019, I thought this would happen and I thought it would happen in 4 or 5 years. So that I was wrong on the timing. So I'm going to hold up my hand here publicly. I was wrong. I thought that in 2018 and 2019, I thought we probably had 4 or maybe 5 years before a sovereign debt crisis would emerge. And in a sovereign debt crisis, I said the dollar would go to 150. So that has not happened. It's been kicked down the road. But I still think that is the likely outcome. I think the dollar, in other words, the dollar going lower is the central banks, the Fed, the US Treasury, that's them still in control. I think them losing control is the dollar going higher. And I think eventually they will lose control. Now, whether that happens next year or next decade, I'm not smart enough to know that. I just know that I'm not going to be surprised when it happens, and I'm going to have prepared for it ahead of time. And the reason I think it goes that high is because, and I've kind of, oh yeah, okay. I thought I lost you there for a second.
No, I shared I'm just showing technically if how 150 is possible It's like a measured move there from this huge base
Yeah.
here. If ever
Well,
that's
this is, yeah. So this was my point I was making earlier. You get above 115, there's from a technical perspective, other than the high in 2001 or whatever, there's really nothing from a technical perspective to stop it. And so, and I always just said it'll go back to its all-time high. So, does it go to 140? Does it go to 190? I don't know. I just think that eventually we will get into a situation where it gets away from everybody. And when you get into a liquidity crisis, kind of anything can happen. Crazy things happen. And so I've always just said it goes back to its all-time high, and I kind of, have used 150 as the general number.
look at is it
And,
is
and
it
it's because the rest of the world, even if the US has to go back to QE, which would not surprise me at all, the rest of the world will have to do it as well.
well,
For the last 10 years, it's not like the US was doing all this money printing and everybody else around the world was, in fiscal austerity. It was a global thing.
I have exactly it's so weird because I was trying to figure out, and I'd love to have your comments on that. I did a poster for members like here's the 10-year yields, the 10-year inflation rate, Brent. Here it
Yep.
tracks the 10-year inflation rate, tracks the 10-year yields. I could have probably done the 2-year yield, and it would probably
Yep.
track the 2-year inflation rate. So over long periods of time, these things they track, right? The CPI tracks. Then after that, I showcased here the 10-year yields for the euro is pretty much the US. Like the yields worldwide. That's why I said if there's hyperinflation somewhere, there's probably hyperinflation in euro also. The question
Yeah.
is, what's the delta between those two yields? And the one who has most inflation, who pays most yields, will attract that currency more, and the currency pair will go up. Here I have the 10-year yields for the US minus the euro 10-year yields. It's not perfect. There's probably other factors in play, but here's the USD euro pair. And you see if the US pays more interests on holding US dollars, my rationale is it will incentivize people to hold US dollars more than euros because you're getting paid more to hold it, right? And it looks like it's great. Yeah.
Yeah. So there's a concept called here's the thing. Whenever I answer these, I already know how they're going to be received. And so I try to be careful about how I come across when I say it, because people will say, well, Brent, in every scenario, in every scenario, you say the dollar goes higher. And my kind of standard answer is, yeah, that's right. So get ready for it. Right. But, but the thing is there's this concept, and I don't know who came up with the concept, but there's this concept of the dollar smile. And that is that on each end of the picture or the smile, the curve is going higher. And on the left side, that's when things are fine and nice and easy and the economy's expanding and there's growth. And in that scenario, the US is attractive because when things are growing, then you probably have higher rates, right? And people want to be invested in the US because of the growth, based on the technology, and it's the largest market. And so in that environment, and you need dollars to participate in the US market. So in that environment, there tends to be a bid for the dollar. On the other end of the smile this is when it's chaos, right? Or when there's some kind of a crisis and the liquidity disappears, and so everybody's scrambling for the dollar from a liquidity perspective. Now, in between, then that's when the dollar goes down, because it's somewhere in between. And it's kind of like if we go back to that chart of the dollar where it's high and it's low and it's high and it's low. In 2020, the dollar went up not because rates were high, rates were very low, but because it was crisis, right? And then 22, it went up because rates were very high. So in both cases, you saw a dollar going higher, but for completely different reasons. And in the time periods in between, the dollar kind of pulled back, and because everything was fine. And where this comes back to is that you don't just have to have higher rates to make the dollar strong. And so I think in 2022, everybody understood that the dollar was going higher because rates were going higher. And I think they forgot that the previous 10 years, rates were at zero, but the dollar was still strong, but for different reasons. And so when they started talking about cutting rates, when the Fed started talking about cutting rates late 20, was it late 22 or early 23? They started talking about cutting rates, and then they finally did it, what, 6 months ago or whenever it was, 3 months ago. But if you look at but from the time they started talking about it until the time they actually did it, you'll see the dollar falling because because markets often move on anticipation, right? They move in anticipation of the event. In other words, it's the actual cutting of interest rates in July. Did they cut in July? I can't even remember. Did they cut in July or September? When was their first cut? I can't remember now. Anyway, but that turned out to be the low, right? Like I think it went lower the day after the Fed meeting. And then from then it's just kind of been a straight line higher. And because in many ways, all of those cuts had already been priced in. And so, and now what you're seeing, I think, is you're seeing the dollar go higher for a couple of reasons. Number one, probably a little bit of a geopolitical hedge with everything going on with Russia, Ukraine, Middle East, Taiwan. There's a little bit of that. The other thing is that in many ways, the rate cuts were already priced in by the time the dollar got down to 100. But then the third thing is not just an expectation for inflation to go back higher, but potentially yields to go back higher as well. And because Trump's policies, even though he oftentimes when he was president before said he wanted a weaker dollar, wanted to cut rates, and even now he's talking about he wants a say on whether rates go up or down. And so from that perspective, many people are thinking that he would be bad for the dollar because he would want a weak dollar. But many of his policies are actually dollar positive. And he's even said recently that he loves a strong dollar. So I think in some ways that was a misperception of what Trump as a president would be from a dollar perspective. And even if he doesn't, let's say even if he does influence the Fed and they cut rates, okay, that's fine. But these tariffs that he's talking about putting them on, even if he were to do, I don't know, let's say he does 25% of what he says he's going to do from a tariff perspective, that's basically the equivalent of a rate hike because tariffs will reduce the flow of dollars to the rest of the world. And if the rest of the world doesn't have as much dollar liquidity, that pushes the dollar higher because they still need dollars to transact on the global stage and to service their dollar-based credit. And so and I think that's why gold is falling as well, is because, gold had a huge run this year on the expectation of all these Fed cuts. And I think part of it was going higher on a geopolitical thing, right? Then Trump gets in and he said, listen, he doesn't want to be part of these forever wars. He wants to wind down the wars in the Middle East and Ukraine as soon as possible. So maybe gold is pulling back a little bit from a geopolitical perspective, but also yields are going higher. And when yields go higher, it doesn't necessarily mean gold won't go higher. I myself have said you're going to get into a situation where yields go higher, the dollar goes higher, and gold goes higher with it. But higher yields and a higher dollar, they are a headwind for gold. Doesn't mean it'll stop it. It's just a headwind for it. And because I think positioning got so stretched, in the 6-9 months leading up to the election, now it's giving some of it back because the expectation for yields to continue falling is no longer there. And in some cases, the expectation for yields to rise is picking up.
It's we had a question there from I think we're on X, one of the members. So it's about President Trump there. So he's talking about eliminating the federal income tax, which according to this person, which would result in massive monetization of debt and debasement of the currency. He wants just your thoughts on that statement.
Okay, so I think there's a fundamental misunderstanding of cause and effect regarding debasement of currency. So if Trump were to do these things that this questioner is asking, that would potentially cause a supply crunch of dollars. And perhaps in reaction to that supply crunch of dollars, they have to go monetize the debt. But they would be go monetizing the debt to replace the dollars that are disappearing. In other words, the dollar is the cause and QE is the effect. It's not that QE is it's not that the QE causes the dollar to go lower. It's kind of a chicken and egg. You can argue which comes first, but the point is that when the Fed comes in and starts monetizing the debt or doing QE or providing stimulus, it's because they are afraid that dollars are disappearing too quickly. In other words, if the dollar is falling already, there's no need to do QE because the dollar going lower is providing liquidity. It's when liquidity starts to disappear and the dollar goes higher, that then the Fed responds and does QE to weaken it. And so if they are debasing the dollar, and I'm not saying that they're not debasing the dollar, I'm just saying it's important to understand this. Think of, what's the right way to explain this? You know, it's like when they're doing QE, they're basically trying to fill a hole. There's a hole in the market from a liquidity perspective. So they're putting more water back into the hole to fill the pond back up, right? So the pond is full with liquidity. But if that pond keeps, if the pond has a hole in the bottom and the liquidity just keeps draining out, they have to keep putting more in just to keep it at the same level. And so it's possible that some of these policies lead to the Fed having to go back and do an enormous amount of stimulus, an enormous amount of QE. Let's just use post-COVID as an example, in which case the DXY goes from 100 to 90 or 88 or 85, whatever the number is. And in that process, the dollar is getting debased. But remember, in order to provide that liquidity, in order to get that dollar to go from 100 to 85, they are doing it by the extension of more dollar-based credit. And so in the same way that the dollar fell post-COVID from 102 to 88 and then rallied back to 113, I would expect the same thing to happen again. The dollar's at 100 now, they take it to 85, and then at some point it rockets back to 115 because the debt that is created in the conditions to take it to 85 eventually come back to the fore and push the dollar higher. So that's what you have to remember with all this stuff is anything that weakens the dollar puts things in place that push the dollar higher in the longer term perspective. Unless the Fed and the Treasury and the US government were to change the law and they were to actually start printing physical dollar bills and throwing them just all over the place. In other words, they create money not by lending it into existence, but by printing it into existence. That would be a fundamental change. And if that happened on a very large basis, then you could probably see some sustained, depreciation of the currency.
Unless other countries do the same thing, then nothing changes, right?
But yeah, and again, if the dollar goes to 80, that means the euro's going to 140, right? The European economy is already in a severe recession, right? Or if you don't think they're in a recession, they're on the verge of one, right? What do you think their export economy does when their currency appreciates by 20%? Probably not good things, right? And so, of course, they will do something, because because there's a lot of euro-based debt as well. If the currency gets 20% stronger, it's harder to pay off that debt. And this is the point I was trying to make earlier. Is every country has a debt problem, every one of them, with the possible exception of Russia. Russia has very little debt. So Russia, Russia has a lot of other problems, but from a debt perspective, they don't have huge problems. But every other country has debt problems. And so every country, central bank, monetary authority, they all have fiat currencies. The plan for everybody is to inflate it away over time. Here's the issue. If they try to inflate away their local debt, it weakens their domestic currency. It makes their local debt easier to pay off. But that also makes their dollar debt harder to pay off. If they try to appreciate their currency, it makes their dollar debt easier to pay off, but it makes their local currency debt harder to pay off. So the rest of the world has a catch-22 that the US does not have, because the US does not have debt in a currency that it cannot control and that it cannot print.
Brent, does that mean that a channel, just like like a range is what's healthiest for the planet? Just a range, like
yes,
just
absolutely.
a range. Let's range,
Absolutely.
and we're fine. Everybody's fine if it just ranges.
That's exactly right. That's exactly right.
So it's a balancing act. So they have to talk to each other. DC, ECB guys and Fed guys, everybody has to talk to each other to make sure the DXY doesn't break everything, or the US dollar.
That's right. And this is why I always say that the dollar falling is that's the world winning. That's the Fed winning, right? Now, again, I think the Fed in 2022, listen, the Fed knew what they were doing. The Fed was raising rates to counter domestic inflation, right? And some would argue they got it under control. Some would say that they didn't. But the point of raising the rates, at least publicly, was to get inflation under control, right? I promise you that they know what that was doing to the rest of the world. When that was happening in August and September of 2022, congressmen, State Department officials, Treasury officials were getting calls from all over the world saying, what the hell are you guys doing? You are killing us. Not only is the dollar going higher, but oil is higher, and it is taking everything we have just to stay above water. And that is why in August and September, the Bank of England had to bail out their sovereign bond market. It's why the European Central Bank had to set up a special facility to buy periphery bonds because their yields were spiking. It's why China's real estate market and stock market started its precipitous decline. It's why the Bank of Japan had to bail out not only their JGB market, but their yen market, because the dollar going higher crushes the whole world. And here's the thing, does it hurt the US? Yeah, it hurts the US, but if they wanted to, the US could have, done QE just for its local industries or just for its local banks. And because they have the chip printing machine, right? But the rest of the world doesn't. And so, I've described this as a Game of Thrones because I kind of feel like that's kind of where we're at in the world, right? All of the debt that everybody has caused everybody to be very edgy at best. And so alliances are being drawn, and old alliances are everybody's trying to figure out who's on whose side. And the US as the hegemon wants to shore up its side of the game, right? And the best way to negotiate with somebody, or if you're negotiating with somebody, the best way to negotiate is when they are in trouble. If they are in trouble and you are not, you have more leverage than they do. And so with the DXY at 112 or 110 or 109 or wherever it was in August, July, August, September, all these countries talk to each other. The central banks, they all go to Basel, Switzerland every other month and have dinner together. They're probably on the phone with each other every day. And the G7 gets together, and they have these all behind the scenes. The US was saying, listen, we are still the global hegemon. You are with us or you are against us. Now make your choice. Right? Now, that's not written in the Wall Street Journal, but that's what goes on behind the scenes. And so, everybody's like, okay, we get it. We're on your side. Now, guess what happened 3 months after that? Now, I can't prove that these two things are related, but 3 months after that happened, when the yen had fallen, by 30 or 40%, whatever the number was, all of a sudden, Japan agrees to spend more on their military to counter Chinese, quote unquote, aggression. And 2 more islands were given to the United States off the coast of Japan to install US military facilities. Now, is that a coincidence? Maybe. Maybe it's just a coincidence, but maybe it's not. Right? And even if it is a coincidence, when they were having those negotiations for those islands, and the dollar was at 113 and the yen was falling precipitously and the JGB market was in trouble, do you think Japan felt like they had a lot of leverage in those discussions? So that's just one example, right? And so, in many ways, we're talking about an economic problem. We're talking about financial markets. But gone are the days of this is the way markets work because it's a free market, laissez-faire, governments don't get involved. We are now at a stage where governments will use everything, including monetary policy, including capital markets, for, strategic purposes, for, national defense purposes, for political purposes. And so I would love it if we could just look at markets just from a purely capitalistic economic standpoint. But I think those days are gone. And I think you have to understand who holds the cards and who doesn't. And I don't want to come across as saying that the US cannot do any wrong, that nobody can hurt the US, that the US is the greatest, That's not the point here. The point is that, like it or not, the US has many advantages that the rest of the world just doesn't have. And despite the fact that the US may not be as strong as they once were in some ways, they still have an enormous amount of tools, an enormous amount of influence, an enormous amount of ability to influence the world around them. Monetary policy is just one of them. But the other thing is, with Trump being in the White House now, his whole "Make America Great Again," that is, it's kind of hard for me to believe that it's happening, to be honest, because, for years I've said capital will flow back to the United States. And despite all the problems, despite the issues, on a relative basis, that's still the only game in town. For global asset allocators who want access to the biggest consumer market in the world, the US is still the place to be. And so, in some ways, people have said Donald Trump will never be able to enact these tariffs because it will lead to this, or it will lead to that, or it will cause a great recession. And this, all of those things may be true, but that doesn't mean that he can't try. And if he even tries, does it have ramifications for the United States? It absolutely does. But it has even bigger ramifications for the rest of the world. And the reason is because of the euro-dollar market and all the dollar debt and all the dollar-based credit that exists in US dollars. And I know I keep pounding on that same concept, but it's really crucial to understand. And so I think Donald Trump's policies, even if he publicly states that he wants a weak dollar, I think his policies will almost necessitate a stronger dollar.
I wonder if he has advisors that are whispering to him the same speech you're telling us, like there must be some people who they agree with you.
Well, I think in some ways Trump kind of gets it.
Yeah.
And I think he's one of the few people that get it, because when he started talking about tariffs, people immediately came out and started saying, Great Depression, Smoot-Hawley, you don't know your history. And he immediately said, you're the one that doesn't know what you're talking about. What they are going to do in order to avoid those tariffs, they're going to come build their shoe manufacturing facility in the United States. They're going to build their cars in the United States because they still need our market to sell into. And if they can build a plant locally and have to pay a 50% tariff, or they can build it in Georgia and pay 0 tariff, and they still want to sell to the United States, where are they going to build their plant, right? And listen, I'm not saying that this is going to work perfectly. I'm not saying that there's not going to be blowback. I'm just saying this is kind of revolutionary. And unfortunately for the rest of the world, this revolutionary strategy that Trump is bringing to the fore is a nightmare for global liquidity. Now, the US historically has been very happy to provide that liquidity to the rest of the world, either via stimulus or via swap lines or via trade deals, however, many ways that they have been willing to provide that. But it's, for the most part, it's almost always been without the strings attached, right? Now, I have a hard time believing that if France needs dollars to bail out, or if they need a swap line to get liquidity in order to save Airbus, while Boeing is having trouble, I have a hard time seeing Trump saying, yeah, go ahead and give that loan to France, who gives it to Airbus, while Boeing goes bankrupt. In other words, I think handing out liquidity is going to be on more of a case-by-case basis. I think it's going to be done to strategic allies. It's going to be done with certain understandings and certain understandings of what can be done with that cash and what can't be done. And so I just kind of think we're in a fundamentally different world. I don't want to say it's different this time, because this has happened many times throughout history, but it is different from the economy we had 20 years ago. You know, we talked about this a little bit ago, that, you know, for 20, 30 years, the world was coming closer together, and now it's fracturing and going back apart. And so but unfortunately for the rest of that's unfortunate for everybody, but, you know, as the world was coming together, the one thing that brought them closer together was the euro dollar market, was basing everything in dollars. That's global centralization, right? But now as the world becomes globally decentralized and starts pulling apart, that glue that held it all together with the eurodollar market is going to start to break. But as that euro-dollar market breaks, that's not bad for the dollar from a price perspective. That's positive for the dollar from a price perspective. And so I think the world is becoming more brittle. It's becoming more prone to crisis. And so I just think it's different. I just think it's different.
So we have somebody. Your time, you're super generous with your time, Brent. There, we have one final question there from a member, and he says, "What are you looking at right now, like, to determine if something is more serious is happening?" And then he says, "The dollar yen ? Any particular levels? Like, what are you looking at right now? Like the biggest piece of evidence where we could be at like a 2001 type of crisis, or 2008, like a huge rollover in U.S. equities, a spike in U.S. dollar. Like, what are you looking at right now?"
And also just to sort of
Yep.
to go along with that, Brent, you know, there's a very clear line on the S&P chart that joins 1929 to 2000 to where we are now. And I think a lot of technical analysts are looking at that, trying to anticipate whether this becomes a turning point for the S&P, and that 95-year resistance line is important or not. So, you know, alongside that is, you know, is there anything that you're looking at that might indicate that we're not looking just at a common or garden recession, but something that might be comparable to 1929 or the 2000? Stock market's falling 50% or more, for example.
Yeah. So the thing that I think is most interesting right now is that the dollar has been rising pretty consistently for a couple months now, but the VIX has been falling.
Mhm.
And the VIX, as I'm looking at it right now as we're talking, and it's at 1398.
Yeah, it's almost dead, isn't it? Yeah.
I mean, it's pretty incredible, right? And it kind of makes sense with markets at their all-time high, or very close to their all-time highs, right? But I would argue that with the VIX at 14 and the Dow at 44,000, or in the what's the S&P's at 6,000?
6,000. Yeah. I mean, it's at that point where it's either a melt up where everything goes absolutely bonkers,
Yeah,
or it rolls over now. So that's kind of what I'm getting to. Do you think?
well, so my base case is that we will get a correction, but I am not in the 1929 camp. I don't think we're going to have this great recession. I don't think we're going to have a great depression. I think the rest of the world might have that, but I think what will happen, and this has been my thesis all along, would be that we will have a sovereign debt crisis. Money will flow out of sovereign bonds, including treasuries. You know, I think the world will still fund the US government, but they will very much may prefer to have higher rates to do it. So I don't think the US is going to have trouble funding the government. But what we could see is money have a preference to be in US equities as opposed to sovereign bonds around the world. And so I think maybe, you know, in the first quarter, maybe even in, I don't know if this happens next week or the next 6 months, but I think we'll probably have another hard drawdown, probably similar to what we had in 2022. Maybe not quite that bad. kind of scare everybody, get everybody, kind of everything kind of reset. But then I think US equities are going to be the preferred place for global capital. And I think especially if Trump follows through on his policies, because I think it will drive capital into the US from around the world. And I don't think it will just sit in cash. I think it will find its way into US companies. And I think it'll find its way into the US stock market. And so I think we could have this melt up that you mentioned. But I don't think it goes straight up from here. Now, listen, I can be wrong. I own equities. But I think what's more likely than not is that we get some kind of a scare. Everybody thinks 1929 is here, and then we get another reversal higher.
Wow. Goodness gracious. Every time I listen to you, I learn something new all the time. It's not easy to understand all the concepts you're throwing around. So it's kind of good that you keep repeating yourself and have the patience to do so, because it's important macro stuff that people should be aware of. No, it's not talking points you're going to hear on MSNBC or stuff like that, right? It's not, there are very few people who have your speech, just, I
Well,
don't
it's
want to
not, I'll tell you, it's not easy to explain.
Oh.
I've tried to make it as simple as possible, but it's not simple. And so if you're struggling with this, don't beat yourself up. I struggled with it for a long time, and I'm the first to say that I don't have it fully figured out. I've spent so much time on this, I can't even begin to count. And so I feel like I have a fairly good understanding, but there's always new stuff coming online. I can of course be wrong, and so I always have to try to figure out where that could be happening. But from a fundamental perspective, it's just really important. I think if I was going to give any advice to anybody as they're trying to think through this stuff, is put your own desires aside. Forget about what you would like to see happen, and just be a total mercenary with regard to what you think is actually going to happen. And I think that will help provide some clarity. That helped me a lot, is once I didn't realize that I was so biased before. And once I kind of realized that I was looking at the world that I wanted rather than the world that is, it helped me a lot. And so, listen, this is the Super Bowl. I mean, this is, if you like markets, if you like macro, if you like geopolitics, I mean, this is the Super Bowl. It doesn't get any better than this. And it's scary, but it's fun, right? And so, by the way, we didn't really talk about your charts other than those at the beginning. I appreciate you guys. I think it was a couple months ago, you guys put out that chart, and because we were kind of right at that 100 level, as I remember it. And it was the big question is, does the dollar go higher or does the dollar go lower?
Yeah, I did that milkshake chart for you, didn't I, Brent?
Yeah.
If Pat, we can just finish on that if you like. If Pat allows
Sure.
the screen sharing, I can actually share that chart.
You know what's fun about being a chart trader? I love the tabletop coffee discussions with the family. I love all that. But at the end of the day, for us, it's kind of easy because either you're trending upwards or you're not. But you know what? Just the words of wisdom you just gave before that, while Kevin's saying that up, I realized that super recently. As soon as you have a stake in something, bias kicks in automatically. It's people don't realize it. I bought gold. Well, I'm always going to seek confirmation bias to justify, in my brain. So
Sure.
It's really the best thing I could tell people sometimes is, let's say you clear out everything. You don't own anything. Well, of course you're going to own, you don't own anything. You're going to see so much clearer because, well, I don't, you see the possibilities when you don't have a stake in something. It's
absolutely.
Yeah, having skin in the game is another way of saying that you're biased. So
right.
I know people always seem to like it if you've got skin in the game, and they don't want to listen to you unless you've got skin in the game. I keep hearing this phrase, and I hate it, because from a scientific point of view, it just sets all my alarm bells ringing. Skin in the game, it's just bias. I would much rather listen to somebody who's got a completely unbiased position, and there's no advantage to them whether it goes one way or the other. Because if you've got a stake in the stock market, then you're automatically going to be, even subconsciously, giving credence to scenarios that take the stock market up. This is a dollar milkshake chart that I did for you there, Brent, and it's playing out really well at the moment. Actually, I know there's a lot of data on there, but if people just kind of kind of sort of focus on the two black lines, one's going down and the other one's almost horizontal, and also focus on this cup shape, the red arc that we've got here. Those are the two main controlling factors on the chart here, really. And the arc is interesting. I couldn't really sort of bring myself to believe that it might actually play out. But taking a step back and trying to be unbiased about it, you have to acknowledge and accept that there is a support line that is taking a broadly geometric arc sort of formation. And these arc patterns crop up a lot in technical analysis. And they're just support lines like any other. You can see the black support line at the bottom. DXY bounces off it goes, comes back, bounces off it, then comes back, bounces off it. And that's a support line. And it's exactly the same with the arc. And really what we can say from a technical charting point of view is that as long as DXY stays within this arc, we know where DXY is going, because as long as it stays within the arc, it's guiding us up to a very critical breakout point somewhere near 115. And if we cross through that critical breakout line, then that's almost for me like a milkshake confirmation line, because DXY really is kind of range bound in very broad terms between around about 115 on the upside and okay, it's declining, but somewhere around 70 on the downside. So it's broadly range bound, but any movement through that 115 level, and that opens up a technical rapid move, it then becomes more likely, much more likely, that DXY accelerates rapidly towards 140, 150, even 160. So I think, yes, I mean, that particular level there is of critical importance. So, I find it a little bit hard when I was drawing this chart to actually accept what it might be telling us, because I want gold to do great.
Well, I think it's interesting that it's interesting that you say that, because so I've owned gold for years. I think it's one of the most important part of someone, if it's either one of, if not the most important part of someone's portfolio. So I think everybody should own gold. And when when I kind of started doing, my deep dive work on this, trying to figure this all out, part of the reason that I knew I was on the right track was that I hated the answer. So to your point that you were just saying, when you were doing this chart, you didn't really like what it was telling you, right? And that's the same thing that I did not like it either. And so in many ways, I don't even like my own thesis, but that's where the evidence keeps taking me, right? And so perhaps that's a good lesson to pass on to anybody listening here.
Yeah.
When, if you get triggered by something, maybe you should take a closer look at that, because it's probably a splinter in your brain that's causing that trigger. But that splinter in your brain might be onto something, right? And so, I fought against it for a while. I mean, this goes back 7 or 8 years now, but I fought against it, right? I just kind of pushed it away, but I just kept coming back to the same answer. And I didn't like it, and I didn't like it, and I didn't like it. And once I finally just accepted it, everything got so much easier, right? And once, and so I don't want to stand up on a soapbox here, but, I think you pointing that out reminded me of the same thing. And that, part of the reason that it made so much sense to me is that I didn't like it. And if you don't like something, there's probably a reason you don't like it, right? And so figure out, why don't you like it? and if it's because, it goes against, your moral perspective of the world, or or the way you think things should be, then you got to take the next step and say, well, is the world really like that or not? And again, I say this all the time. In my opinion, the best money managers are just the mercenaries. They just don't care. It's just a dot on a page. I don't care what the asset is, right? And that's kind of how you have to be. I almost, I don't know if you guys ever do this, but sometimes I'll put a chart up on Twitter or something without the title.
I've said what do you think of this chart? Yeah, block the title off. Yeah.
Yeah, it could, because the title automatically influences how you're going to interpret that chart.
Yes, of course.
Yeah.
And you could invert the scale also.
Turn it upside down. Yeah.
Exactly.
That's another
Exactly.
trick.
Yes.
So-
Those are tricks to eliminate bias right away. You like it, yes or not?
Yeah.
That was that was a Bitcoin bullish. I hate cryptos, blah blah blah. Or I love them, and they can't see. They're clouded. It's crazy.
Yeah.
It's like a cult of thoughts. It's bonkers there. It's crazy. So
Yeah.
it's good.
So
Anyway, it's a crazy,
to
crazy world.
just to sort of finish off there, Brent. I mean, both Pat and I really appreciate you taking the time to explain all this, and I hope the people watching this podcast really, appreciate the time and the effort that you put into all of this. And I know you will continue to challenge your milkshake theory as new fundamental news comes in. The Trump administration has come out with some bizarre statements about killing inflation, and would that involve cryptocurrencies, and goodness knows what he's got on his mind. But the fundamentals can change, so I know that you will be constantly assessing those. And whilst you're doing that, Pat and I will be looking at this milkshake chart and constantly testing it to make sure that it's still on track. And should anything change, obviously we're in contact, and we'll let you know. So
Yeah, I appreciate it.
we've got you on your side, sort of checking all the fundamental sides of what's going on, and you've got myself and Pat looking very, very closely at how the technicals stack up as well. So between us, hopefully we'll be able to have it covered. But thank you so much for taking the time to talk to us, Brent. I mean, we really do appreciate it as always. And it's at Santiago AU Fund. Is that right? I'm trying to remember.
That's correct.
Santiago AU Fund on X. And Brent Johnson, everybody, the originator of the milkshake theory. Thank you very much for your time.
All right, guys, have a good one.
Take care, Brent.
Bye.
Thanks a lot, Brent.
Please subscribe, like, and hit that notification bell. Thanks, guys.